Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings. Today, we're diving into STONERIDGE's latest quarterly report. Let's see if this company is cruising along smoothly, or if there are some speed bumps ahead that might cause them to stall out. STONERIDGE, a company making parts for cars and trucks, just released their Form 10Q. It's like a report card. But instead of grades, we get to see their money situation. Did they make a profit or did they lose money? Are they expanding or downsizing? Let's get into it. First up, the balance sheet. This is like a snapshot of what the company owns and owes. It's a critical document to determine company health. Think of it as their physical. Are they in great shape or are they overweight? Accounts receivable are at about $156 million, up from roughly $137 million at the end of last year. This means more customers owe them money. That could be a good sign, but it also means they are at risk of not collecting the money. They also owe $203 million in their revolving credit facility. That's almost unchanged compared to the end of last year. That's quite a lot of debt, which might indicate some financial pressure. Their retained earnings, which shows how much money they've kept over time, is $172 million. That's slightly down from about $180 million at the end of last year. They lost money this year. Now let's move on to the income statement, which tells us how well the company performed over the last 3 months. It's a good thing we are doing this since they lost money. Net sales came in at around $17 million. This is a significant drop from $239 million from last year, losing about $20 million in sales, equivalent to about 9% drop. It is like losing almost 1 in 10 customers. Warren Buffett would not be happy with this trend. Operating income is negative at about negative $3 million. Last year they had a very tiny profit. Clearly the business isn't doing as hot. They report a loss per share of $0.26. Last year it was slightly better at a loss of $0.92. The statement of cash flows tells us how the company is generating and using cash. Cash is king, and the cash flow statement helps us understand where the money comes from and where it goes. Even though the company reports a loss about $7 million, the operations actually generated $10.08 million in cash. A disconnect of these two numbers might be a signal that the company is using accounting tricks to paint a worse picture than things actually are. However, in any case, it's good they are generating money. They haven't borrowed more money. In fact, they did not use it this period. Overall, their cash position has improved. Next, let's check out the statement of shareholders' equity. This shows how the owner's stake in the company has changed. They did not issue any new shares, which is a relief. They repurchased some shares for treasury, which usually means management thinks the stock is cheap. But take a look at this term, accumulated other comprehensive loss. This is a fancy name for losses in value of foreign operations. This shows that if you are investing into a global company, make sure you look at foreign exchange rates, or you might be in for a surprise. Let's scroll to recently issued accounting standards. This part discusses new rules that will affect how they report their financials in the future. One thing to watch out is that the company is assessing new standards by the FASB in the coming years, which will impact disclosures and might change their numbers and how we see them, so that can be quite concerning. Now, revenue by segment, this is where we see the business broken down by what each segment is bringing in. Their biggest sales comes from North America, so naturally as investors we need to pay attention to that. It seems like their performance is determined by when parts are shipped. Inventory seems to be pretty consistent across the time periods compared. Let's scroll to the derivative instruments section. This tells us how they're using financial tools to manage risk, especially with exchange rates. They use something called foreign currency forward contracts. Fancy word for hedging. This is like insurance they take to reduce their profits because of countries' currency fluctuations. The section on share-based compensation details how they pay employees with company stock. It's pretty significant at $1 million. This is quite normal. Now let's look at their debt situation. Debt can be a useful tool or a heavy burden, so it's important to understand how much they owe. They have a revolving credit facility of $275 million, and at this point they have used $23 million. That's a hefty amount of debt, and it comes with covenants, which are rules they need to follow. It seems like they needed to loosen them and amend their financial terms with lenders recently. In the loss per share section, it mentions if there are shares that would have made the loss look better, they are not counted because it's not appropriate. The company has commitments and contingencies which are potential future obligations. They have an environmental issue from an old location which will set them back 200k and has been a drag for about 15 years. Product warranty and recall section says they set aside money for warranty claims. They are currently fighting some of those claims in court. The company implemented something called business realignment, which usually means they are laying off people. That cost them about $2 this year. In general, they made the expense in operations to then benefit from it. The income tax section is a bit tricky, but it shows how the company is managing its tax obligations in different countries. Their income tax calculations varies depending on which country they made their profits and in which state. The financial information presented below is for our 3 reportable operating segments. AppTU, the section on segment reporting, breaks down the company's performance by different parts of the business: control devices, electronics, and STONERIDGE Brazil. It seems like electronics is their biggest source of operating income, so the sales drop is felt in that specific segment. Their geographic sales comes mostly from North America. Let's scroll to the risk factors. This is where the company lists all the things that could go wrong. So if the lawyers are worried, we need to be worried too. Finally, there are some certifications signed by the CEO and CFO promising that the report is accurate and honest. So what's the story here? STONERIDGE appears to be facing some headwinds. Sales are down, debt is high, and costs are up. Their financials seem weak, and the recent need to change covenants signals liquidity issues. I would say there are better companies to put your money into. I'm not an investment advisor, so don't take this as financial advice, but hopefully this video has given you a clear picture of STONERIDGE's situation. Thanks for watching. If you found this helpful, be sure to like, comment, and subscribe for more deep dives into corporate filings. Until next time.